Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Cintas Corporation, ticker CTAS. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. Let's dive on in. Market cap 40 billion, EV of 42 billion. So you have about $2 billion in extra debt on this company, which is providing some leverage to the business. And we can see how that impacts the return on equity shortly. It's operating in the commercial services and supplies industry. They provide identity uniforms and business services in the United States, Canada, Latin America through uniform retail, rental and facility services, first aid, safety services, and other segments. They rent and service uniforms and other garments, FRCs, flame-resistant clothing, mats, mops, and shop towels, restaurant cleaning services, and supplies. So this company provides its products and services through a distribution network, local delivery routes, local reps to small service and manufacturing companies, as well as major corporations. So this whole description sounds like a really good business model to me, because if you think about it, all these things are really important, but they're not going to be the main business model of the company. So they might be aware of them. They might want to manage them on price, but it's possible this is a relatively underserved niche. If you think about it, I mean, people are going to need uniforms, they need rentals, they need first aid and safety stuff, but that's not going to be their key business model. And so you might be able to get good pricing power because it might be a small portion of their overall cost structure. Now the beta 1.4 is kind of high, so we'll see how that plays out. But when I reach down here and go to the return on invested capital, I immediately see something I really, really like. These numbers look good without even going over what the numbers are. First of all, 20 straight years of profits. Great sign when you have 20 straight years of profits. You want to see that. But also what I'm seeing is very strong stability from year to year. You're not jumping around up and down. You can see this simply with your eyes when you're looking at this. 11%, 11%, 11%, 11%, 11%. And look, from year to year, 2005, 11.82%. 2006, 11.83%. It goes 1 basis point difference in return on invested capital from year to year. That is incredibly low. So for 5 straight years, you're running 11%. 2008, 10%. Now in 2009, they do drop down to 7%. I don't know if this is maybe an acquisition or something. It could have been a big change in the business. But since the drop in 2009, since they bottomed at the 6, 7%, 09 and 010, they have steadily grown their return on invested capital into the double digits, and they're soon approaching 20%, which is really, really attractive. You see this steady improvement over time. That sort of improvement is very attractive for the long-term returns. If we simply look since 2013, you're at 9%, 10%, 12%, 21%, 11, 15, 15, 14, 18, 19. So you're getting into a very attractive territory once you get over that 15% return on invested capital. And that's return on invested capital. That's not return on equity. Your return on equity here for the last 10 years is 28.7%. That's very attractive. When I look down here, it's been above 20% every year since 2015. You're looking at very strong numbers here. This is what a high quality company is going to look like. So very excited so far. Now, as with most high-quality companies, you immediately run into the problem that other people recognize them as high-quality companies, and you get a high PE ratio. PE of 32 is really hard to justify. This price is likely too high for me to pay, but I'm already on track to putting this type of stock on my watch list because everything on the quality side is looking really attractive. It might be possible I get a good price in the future, but the quality stuff is here. I mean, you see, they're turning on revenue growth of 6 to 7% into free cash flow growth of 15% and EPS growth of 17%. Those are very strong numbers. I mean, you're seeing operating profit triple over the course of the decade, even though revenue didn't even double. So you're seeing some operating leverage. The operating margin's grown from 13% to 20%. Very, very strong. You really like to see that. In addition, they are paying a dividend. So it's not like they're getting this all without paying dividends. They are paying dividends. So everything looks really good here besides the price. We're looking a little overvalued, but definitely a high quality company. If you're enjoying this video so far, please hit that like button. I need your like buttons. Every video that tells the YouTube algorithm that you're enjoying this content, that you'd like to see more of it, and that YouTube will then recommend it to other people. So please like this video. If you want to see more videos like this, don't forget to subscribe to my YouTube channel. Click that bell so you can get notified when I upload new videos each and every week. I'm working through every company in the S&P 500, and that means you can get notified as I upload those videos covering your favorite companies. Now, income statement. See what we can figure out here. Now, they have grown SG&A about 2 times. But again, they tripled your operating profit. That's really good. And you can see that operating leverage flowing through. They are paying some interest income, but it's not a huge amount. So that's not a big problem here. Now, what you can see is they're getting some boost to their EPS growth because they're buying back shares. You started the decade with 125 million shares outstanding. You end with 106 million. So you've bought back about 20% of the shares that you have, maybe a little less than 20% over the course of a decade. It's not a huge multiplier, but an extra 1-2% per year in EPS growth simply due to those buybacks. That's a really attractive thing to see. Now, you've grown your PP&E by about 500 million, but you've grown your income by $1 billion. That's what's driving this big growth, because you did have some acquisitions occur along the way. You see a big growth here of goodwill between 2016 and 2017 that does jump up your PP&E and been a big driver towards that. But because you're not growing your assets that much, your asset performance is getting better and better over time. You really like to see that. They've taken on very little amount of debt. Basically, they're at $2.4 billion in debt, not a lot of extra debt. That mainly came from that acquisition time frame. Capital leases are added in a little bit towards the end, so that has some effect. But overall, things look good here on the balance sheet cash flow statement. You do see stock-based compensation. It's basically 3 to 4x over the last decade. I don't like seeing that, but you're seeing that each and every year they're buying back substantially more shares than they are issuing, so you still get that reduction in share count over time. As long as you're doing this, then the stock-based compensation is to be expected. It's pretty normal for large companies. So although I don't like it, it's not something I spend too much time fussing over. You do see the acquisition spending here, spending $2 billion in growth for 2017. That's of course driving your goodwill jump here, adding about 1,500 in goodwill. That basically means that they, took on only extra 400 million in PP&E. The rest of that purchase price goes to goodwill, and that's a big driver. Overall, everything here looks really good. I like what I'm seeing here. I think Cintas Corporation would go onto my watch list. The stability in the return on capital is key. The more stable your return on invested capital is, the more reliable future projections can be. In addition, the slope of improving return on invested capital is also important, because it means that your operating leverage is really starting to drive through. You're starting to get that scale where you can increase your revenue and gross profit without having to increase a lot of your SG&A and lower costs. And that means that you're going to get more and more profitable over time. That's driving this double-digit EPS growth despite only growing revenue at 6-7%. So for me, goes on my watch list. It's a little high to buy now with this PE ratio. I like to buy these things with these sorts of metrics in the 15 to 20 PE range, ideally below 15. So your price would have to drop by half to get to there. It's possible, though, depending upon how this market goes, that you might get an opportunity. So for me, Cintas, watch list. Thank you for listening. Please hit that like video. Don't forget to subscribe so you can get updates as I go through each and every company in the S&P 500. I will touch on your favorite companies, and so you need to subscribe to get those notifications. Thank you for listening, and until next time, stop paying fees, start building wealth.